back to another episode of the Cost Management Center podcast. I'm Dwayne Deason. I'm your host. And with us today, we have Keith Burgess from NFP. And we're here to talk about health insurance, how that's a major issue for companies. And that's something that we want to focus on. It's been a rising and increasing issue over the years, and it doesn't seem to be slowing down at all. So hopefully we'll be able to give some good strategies on how to combat those rising costs. Keith, welcome.
Thank you.
I wanted to start with a little bit about your background and just tell me a little bit about yourself and how you got into this business.
Sure. So I've now, hard to say, but I've been in the business for about 30 years. I grew up on the Eastern Shore, went to University of Maryland here locally, majored in finance, management, marketing. So I was a college wrestler, and that's how I got introduced to the business. So the guy that I started working with is named Alan Meltzer, and I met him right out of college. He was a college wrestler, so he brought me into his little Meltzer group, and 30 years ago started actually in the life insurance business. And our clients liked what we did, and they said, do you do health insurance? Do you do retirement plans? So we kind of got into all the other aspects of corporate insurance, it being with health insurance, group benefits being the major component of that. So yeah, I've been doing it for 30 years, and now I live in the Bethesda, Maryland area. Yeah, it's been great.
Wow. And it's rare. In fact, one of the things I was really excited to be talking to you about today is that the industry has changed so much over time. And I have someone here that knows a lot about that history. And sometimes it's good to understand that background. But what has the company done that made you want to stay around for 30 years? And it's very rare these days that employees stick with one employer for so long.
That is the truth. Yeah. So I again, we started out as a very small company. I think I was the second or third employee. Alan, there's never any formal training, but he just kind of gave me some old clients to go talk to. And that's how I learned from, kind of going to appointments with him. But yeah, it was just really a family run business to start with. So it was, I think he had 7 Division I college wrestlers working with him at one point. So it's kind of a family thing.
The tie-in, I see.
Yeah. So, but it grew over the years. It grew to, over probably 200, 250 employees. And so it was a great company to work for. I mean, I did take a hiatus for probably 5 or 6 years. I started my own real estate development and construction company for a while. I went to the markets and took a dive. Yeah, I took a dive in 2006, 2007, and I jumped back in the insurance business. So and I did. At that point, I looked around and said, what other consultants, brokers are out there so I looked at the market and came back to the Meltzer Group, which became NFP. So I just always thought they treated people well, and it was a great place to work. And they cared about.
And you're saying from 3 to 200 in that time period. That's number of employees. That's impressive. The other thing that just caught me that I found interesting was that you talked about the Wrestlers in Business Network. And it just got me curious. Do you all is there any sort of that you get together and you still wrestle a little bit to keep in shape, or are those days long gone?
Well, for me, those days are long gone. I mean, I've been out of the sport for many, many years, and it's a hard sport to continue to do. I mean, it's very challenging to the body. And
I agree with you. I would not want to be on the mat. Well, let's dive into a little bit of the health insurance costs and talk about that. Within NFP, so on a day-to-day basis, how do you live and breathe kind of this area, this health insurance? Are you in the field every day? Are you actually helping them manage those their benefits? What is your role on a day-to-day basis?
Interesting question. So my role has changed dramatically. I mean, again, 30 years ago in the business, I was purely sales, trying to bring in new business. From a broker standpoint for health insurance, we did renewals once a year. There was very little negotiating. There was, as you know, there was very little transparency. So data is now the driver. But back then, employers just kind of had to. Well, our job was at renewal time is to shop the market, but now it's changed. My role now is I have a clientele. Personally, I have a clientele. NFP has a whole team of people. We're talking about just employee benefits here. So employee benefits, we have an entire division with a couple hundred people that manage our clients. So, I'm still kind of for lack of a better term, a producer where I'm out in the field, seeing clients, trying to bring in new clients through referrals. And I stay very involved now, kind of unlike my role many, many years ago. So I stay very involved. So I'm, talking to the clients or staying in constant contact with the clients. But we have a whole team of people behind us that do a lot of the service work, that do the day-to-day claims management and strategy and data. And so we, it's a whole team approach where I do stay kind of as the relationship manager involved, and I'll hear from the clients, especially when there's issues that we need to resolve. But I kind of stay a lot more involved. So the role has changed, but I try to stay very involved with the clients.
And I want to just go back into the history a little bit. And when I wrote my book, I put a story in my book about how when health insurance first started, it's not when I first started my business and offered health insurance, it was probably the mid 90s. And everyone thought I was so generous because I paid for 100% of their health insurance costs. And the ironic part about it, if I remember right, I want to say it was 160 for my males, and it was 180 for my female employees. So I'm wondering if I remember that wrong, because it almost seems too low. And over the years, it went up a lot then too, but it was still so low. It wasn't enough to move the overall profitability needle for my company. And now it's become just a behemoth of where insurance per month per employee, or it can be, depending on the plan, can be a couple thousand to the employer, which they share that cost. Am I recalling correctly? Is that what you recall as well, or is it you think my memory might be fading there?
No, you're right on. I mean, I remember for a family it would be maybe $3,000 to $4,000 a year max for
right
back in the 90s. Now it could be $23,000, $25,000 a year, and you're right, that cost, which used to be 90, 100% carried by the employer because it was a much smaller piece of your overall budget. Now health insurance under salaries is the biggest cost to a company. So yeah, I mean, those costs were pretty much right on.
I also remember that it being much more simple. Like there was very few variations of the insurance. And as far as you had the basic, you would have a PPO, then they started getting to more managed network. I mean, they started to expand in that way. The number of different, you can adjust all your deductibles, but I seem to recall it was much more simple, and there were a lot less additive, I guess, types of insurance that maybe there was dental insurance, maybe there was then eye insurance, there's a separate one for vision, but over time now, there's now separate ones for fertility. I just remember a lot different choices than there were before. Is that the case as well? Has it gotten not only more expensive, but much more complex as far as the offering?
Oh yeah. I mean, definitely a lot more complex. I mean, again, 30 years ago, health insurance was pretty simple. I mean, it didn't have much flexibility, but it was simple. Most employers would offer a single PPO or an HMO, like you say, the managed care networks. I mean, sometimes they'd have two options, but really it was very low deductibles, low copayment, very modest, if any, employee contribution. The average deductibles might have been $250, right? It's the out-of-pocket maximums. They were even rare. There was no out-of-pocket maximum at one point, but the employer carried the lion's share of that. There was also very little transparency at that time, so everything ran through paper claims. The broker's role again was mainly transactional. The quote was here. So now beyond medical, like you said, they might offer some dental insurance, maybe some basic life insurance. Once in a while, you'll see some disability coverage, but nowadays you have a litany of products that they offer as a basic package that, a new employee might get medical and dental and short-term disability, long-term disability, life insurance. And then you also have a litany of voluntary products, and the voluntary products now, like you were saying, it could be a whole list of different types of products. So it's changed dramatically.
And what do you think has been the primary reason for the rising costs over the years? Because some people, they put to prescription drugs going up quite a bit in costs. Some say it's the amount of medical equipment and advancements that is causing that. I don't think it's really the doctor compensation and that aspect of it. But do you think there's a particular element that's a major driver, or is it really a combination of things?
I think it's a combination of things. I mean, the biggest factor I'd say was the specialty pharmacy drugs. They've been a huge cost, increase. Let's say you have an employee, your employee group is 100, 200 people. I mean, if you have 2 or 3 employees out of that group that have very high pharmacy costs, they could be hundreds and hundreds of thousands of dollars that could make a huge difference. There's also, I'd say secondly is, maybe chronic conditions have become a really big reason, diabetes, obesity, heart condition, heart disease, those are always on the climb. I mean, those are lifestyle driven, changes, and those are expensive to manage. So those are some of the biggest things. So another thing I think is provider, consolidation. The major carriers, the health insurance carriers, you only have a handful of carriers left. So, that increases, they control the marketplace. So the costs have gone up a little bit there. Provider consolidation too. And you see hospitals buying up physician groups. That reduces the competition, increases the negotiated rates. So it's also the administrative piece, the technology complexity. I think all those pieces go into what's driving the cost. Utilization patterns. That's probably the last thing is here's an interesting fact. Post COVID, higher claim volumes. Why is that? Because people were deferring all that care for many years, and now people were staying home. They weren't seeing their physicians. So we're seeing much higher claim volumes. So, I mean, I'll give you an example. When we go to talk to our clients about the renewal process, let's say they have United Healthcare or CareFirst as their health insurance carrier. Well, these carriers, the way they price things is they hope that if you're at about a 78 to an 80% utilization rate, meaning that, give me an example, let's say that your company's paying a total of $1 million in premiums. So if you're at an 80% utilization, that means they've paid out $800,000 in claims. That's about where they want you to be, and that's kind of a break even because they have administrative costs and salaries, obviously. But we've seen in the last couple of years, most employers are running at closer to 100% utilization, 110%, 120%. So it's very difficult, and it's all data driven now. So everybody knows what's going on, why their plan is more expensive, what are the cost drivers. So it's making costs go way up.
Yeah. So I think that's one of the things that I also found true. What you said there is that a lot of the times the big drivers, companies have relatively few employees that have a serious accident or serious illness or serious condition that can be either temporary or permanent. And the problem is that's the cost that has risen a lot, is that a lot more advancements in medical equipment and prescription medications and such for those more severe cases has really driven up the cost. It's not so much your average trip for a checkup at your annual physical. That's not what has gone up in cost exponentially. It's really that much more serious illness where they have much better treatment for it, but that comes at a significantly increased cost.
Exactly.
Okay. All right. That's good background there. Okay. And then one of the other things that I am going to get into this a little bit later, fully insured versus self-insured, because back early on back in the 90s, I seem to recall there was very little self-insured. It was almost all insured by the carriers, full insurance. And then it started to switch over for that. How do you think that's worked out for companies versus that change? Has that been good for companies, and who won out of that, if anyone?
I definitely think it's been good for companies. All companies, small, medium size, large. I mean, the smaller companies, traditionally, like you said, the history is the smaller companies, they didn't have any choice. They had to be fully insured. The carrier, candidly, the carrier took all the risk, but they kept all the data. So the employers, they had to pay pretty much whatever renewal increases were thrown at the end of the year because they had no data and they didn't really see what's going on. I mean, the larger companies, they've kind of always had if you were large enough, there was always self-funding strategies. They'd pay claims directly and use some sort of third-party administrator to administer the claim. So they kind of had the advantage there. Now, over I'd say the last decade, maybe decade and a half, we've seen these level funding programs. They're kind of bridging the gap for some of the smaller mid-sized firms, is because, we say self-funded or partially self-funded, which means, and level funded is kind of one of those where the mid-sized employers, they can stabilize some of their fixed costs, with the upside of a little bit of self-funding. It's kind of baby steps towards self-funding. But captives have also become a huge thing for smaller groups, where they can pool their risks together with other like employers. There's some risk in that, but if it's a big enough pooled group of employers, captives could make sense. But more transparency now.
One of the things that I found that contradicts that a little bit. To my former clients, and they were large, is that they were fully insured, and I took a look at our options, and of course the carriers and brokers would say, you really ought to be self-insured, And we were running at a little bit higher claims to premium value. And I thought, you know what, I'm going to stay on fully insured for a period of for at least one more year. Every time I've won on that, every time where the claims came back, in some cases, over 100% of the actual, what would have been the premium cost. So the carriers lost. And now, of course, the next year, they want to have a different conversation because they want to catch up on that.
Sure.
But for at least for that particular year, I would have paid much more had I gone self-insured. And I probably have done total of 4 or 5 years with a combination of companies where we've been self-insured, and I've won every year in that way. And I just thought that and it's interesting on how many people, every expert I've talked to always says that self-insured is the way to better manage your costs and to keep health insurance costs not under control, but better under control. I had a little bit different experience. Do you think I just got lucky, or do you think what are your thoughts on that?
I mean, our experience has been the same. It really depends on the employer. You have to really dive into their claims for the last, 3 years, 5 years. I mean, that's really more like last 2 or 3 years because, as you know, employee groups change so dramatically nowadays that it's hard to look at a group. But anyway, claims data is the biggest driver. But we tell people, I mean, you got to be you can't be a company that's, kind of living, for lack of a better term, paycheck to paycheck. They have to have some reserves in order to kind of carry that if they're going to do fully self-funded. But you really need to kind of if an employer wants to look at self-funded, they have to be willing to give it a 3 to 5 year opportunity to, usually over 3 to 5 years, right. I think the employer makes out. So, I mean, as you know, you have to have, you're taking a big risk, but you can also set how much of the risk you want to take. And then you can have kind of insurance kind of picking up once you hit a certain cap, once you hit a max by insurance to hit that. But yeah, we've seen if it's the right size companies, and again, it doesn't need to be a huge company anymore, but some of these level funded programs is kind of is bridging the gap because you could kind of set your level of risk where you want it, where you're not quite as exposed, where, we show people, here's your maximum exposure, which is not much more than you're paying now, but you have the upside to share in some of those savings with the insurance company versus the fully self-funded, which you're talking about, where you're taking a lot of exposure.
Right.
So, and then we've had success.
Okay. I mean, that's great, but kind of great feedback. Now, let's just talk about kind of your approach when you first walk into a new client. The data you collect, what are you looking for? What do you typically find as far as whether that's opportunity, or do you find that for the most part that there's really most companies are doing the exact same things and there's not so much you change their strategy? But give me a little insight on kind of the new client experience when you walk in the door.
Sure. I mean, what I'll start with is sort of like the carriers have a lot of consolidation, is our industry has also had a lot of consolidation. And our market, there's a number of very strong players. I mean, I don't badmouth my competition. There's some strong players, and there's been a lot of consolidation. Consolidation can be good or bad, as you know. We really want to see the demographics of the company, learn a little bit about the company, learn about their culture. We don't just jump right in, but we definitely look at their claims data. We look at if there's any cost inefficiencies. The biggest piece, as we talked about before, is pharmacy management. How are they managing their pharmacy utilization? So we'll really we'll do a comprehensive claims analysis. We'll also look at all their contracts. So what are the claim drivers? I mean, we try not to come in and say we're going to promise a bunch of savings. Although I think there are areas that we initially will look at. Like I said, the pharmacy benefit management arrangements, underperforming networks they could be using, unnecessary fees that could be buried in some of their contracts. We try to be very transparent. I mean, the industry is actually very, very transparent now when it comes to fees and commissions. I mean, there's disclosures you have to provide, but we've always been that way. So, I mean, one of the areas we do try to find savings on is uncovering and showing employers, here's what you're paying. Here's some of the inefficiencies that some of the carriers are using. Here's all the commissions and fees you're paying. We try to strip all those out and say, we'll do it at a lower cost. But yeah, so those are some of the things that we'll do. It comes down to really diving into their claims, diving into how they're utilizing their plans, what type of tiered network opportunities they're giving their employees.
It's good information. So let's get into a little bit about those different kind of cost strategies, because you kind of started us down that road. I think you mentioned two there that caught my ear. The first one is just that you look at what they're currently paying as far as commission. Essentially, usually it's underlying commission to the brokers that they're getting from the carriers. So there's that aspect that you can negotiate or discuss that with your broker and come up with something that is reasonable. But then the other aspect is a little bit more on, you talked about pharmacy management, and I've heard that as a major cost savings potential. Can you talk a little bit about what that strategy entails?
These PBMs are called pharmacy benefit managers. Just to kind of give you a backdrop of that industry is, again, it's become, I don't know, almost 30% of the cost of health insurance now. It's a big driver. But there's been a lot of, again, back to the theme, there's been a lot of consolidation in that industry. So, I mean, just to give you an idea, 80 to 90% of that market is controlled by 3 players in that marketplace. And that's, you might have heard of them, CVS, actually.
Sure.
CVS is the largest, and they bought Aetna. So they now own Aetna. So they're a big player in the marketplace. Express Scripts, Cigna owns them. And then United Healthcare owns Optum. Those are the 3 biggest players. So they kind of control the marketplace. And, you know, they, like I mentioned, they probably provide 80, 90% of all of the prescription drugs that are written. So back to your question is, how do we dive into that and see where we can save money within the prescription drugs? And that's, you know, that's a constant kind of negotiation on which drugs are formulary and non-formulary, and each carrier looks at it differently. But what we try to do is, you know, NFP as a company now has their own proprietary pharmacy products. So we'll do what's called a carve out. If the company is big enough, we'll do a carve out. We'll analyze their utilization. We'll carve that piece out. And so within that space, there's all these huge discounts that these companies they'll keep because they control the marketplace. So all these discounts, the employers are not seeing those discounts. That's how those companies are making a lot of their money, on these discounts provided to these pharmacy drugs. So if we do a carve out, you know, the company could immediately see a 20, 30% savings just on their pharmacy, because we carve that out, and we'll hire an administrative to kind of help administer those costs.
And I just want to make sure that, because you're using terminology, carving out, what that means is that you'll go to the carrier and say, yes, we're going to take your health insurance and we'll follow your plan and your network for that. But any pharmacy, we are carving that out and we are giving it to a different company to manage that piece of it. So we're going to take that out of the carrier's responsibilities. That's what you meant by carve out.
That's correct. And they know that that's where they make a lot of their money. So they'll immediately be willing to negotiate. So whether we end up actually carving it out or not, that's when they really start negotiating the price.
Okay. Because what I've heard is that, so you can go out and outsource it, your pharmacy, to one of the other discount, and I use GoodRx just because it's one of the larger in the public company that does that. And it's powerful in the sense that you're not telling anyone they can't get a prescription. You get the exact same medications. It's just a matter of, now you can't walk over to CVS anymore and pick it up. A lot of times it can even be mail in. That type of structure can lower costs quite a bit.
I mean, the mail in, doing 1 month or 3 months worth of prescription drugs has always been kind of something that can be recommended to save money. When we do carve outs, I think you're still able to go to the CVS and Walgreens and get your prescriptions filled. It's just through a different program, like you were saying.
Yeah, that's true, because exactly. I use GoodRx. Now that you mentioned, I use GoodRx. When I use GoodRx, CVS, I don't know if they have to, but they honor that discount.
They do, and they actually suggest it sometimes now.
Okay, interesting. Right. I don't know if they're supposed to, but they do.
Yeah, but the counter people are trying to be nice. Yeah, see how expensive these drugs are.
Yeah, they realize that everyone's suffering here a little bit there. Okay, so that's two areas that you can try to kind of save on, and then we talked a little bit. We got into how you can put pressure on the carrier, and in some ways that's gotten more difficult because there's fewer of them, right? So they've consolidated, and now you really only have a handful that you can go to in order to try to play off of each other. And from a practical standpoint, switching carriers is very disruptive to employees. They don't like that at all. And to make that even more complicated, sometimes different carriers have different strengths in different markets. And, if we go with what is usually a more expensive Blue Cross Blue Shield, they might be real strong in one area, and then all of a sudden we say, no, we're sitting over at Aetna, and they have much weaker network in that area. You have employees that could be losing doctors that they've relied on and that they trust, and so that's a big deal. But as far as you can play, you try to play the different carriers off of each other and do RFPs. how often can you really get away from that? Can you RFP every year? I mean, it seems like that. And, at some point, the other carriers get tired of putting bids in when they keep losing, or do you generally recommend RFPs every year?
So in the local marketplace in the metropolitan area, we're the largest provider of healthcare, and so which means we're the largest broker consultant for all the different carriers. So, but we're pretty aggressive. So they know we're going to come back every single year, whether we're going to change. I mean, they know, just like the employer knows, we'd rather not change every year. You really should try to stick with a carrier for 3 to 5 years when you go with them, because it is disruptive to the employees. But, we do negotiate every year because these costs are going up so dramatically. But, back to the earlier conversation, is the company may be very limited as well to shop it around. If their utilization, let's say, is 120%, which means they spent a lot more money than the premiums they paid, they may have a very difficult time going to try to shop it out to the other carriers. So, if they get offered an increase of 25% increase to stay with, for example, United Healthcare or Cigna, and we go out to the marketplace on their behalf, the claims data that's out there, right? So, I mean, the other carriers will see that. And so then they'll say either will not quote at all, they'll do a decline the quote, or they'll just say that they can't be competitive. So, we're kind of pigeonholed. So that comes back to our relationship with these carriers and just saying, look, we'll keep them with you guys, but you got to do better than this 25%. We've got to try to get it down to 12, or whatever we can do to try to get it down. So, I mean, we have a lot of, again, back to the fact that we have a lot of clients in this marketplace, so we can put a little bit of pressure on the carriers to work with us. But it's difficult. The last couple of years has been very difficult because we've seen a lot of situations where we can't get other carriers to bid on the work.
One of the things that I also had success with, which I'm not sure my brokers appreciated, by the way, is that towards the end, when we're facing, it's funny because I know this year you're talking 20, 30% increases in some cases, maybe even most cases. I want to say, we were facing a 12% increase, and I was so livid that I actually asked to speak to our carrier, which brokers did not want. But I did, and I behaved myself. But you know what? They came down after the call. Is that part of what your strategy is, to actually sometimes introduce the clients and let them talk to the carriers as a strategy, or is it you're usually there's nothing good can come from that?
No, we've done that. It's funny you say that. 2 weeks ago, I was on a call with a renewal, and again, we were limited to the carriers we can go to. And the employer was just, a lot of times depending on the size of the company, usually, the HR division of a company will handle the renewal. Sometimes finance will get involved, whether it's a CFO or head of finance. And rarely the CEO of a company will get involved. But I tell you, we've had a lot of CEOs on calls recently because when you're getting a 30% increase, they're pissed. And their initial thought is like, why are we using NFP? Go to a different broker. They don't understand that if they go to a different consultant, they're going to get the same pricing.
And actually, even when their claims and rising costs,
those things, right. But yes, so back to your question is, yes, we've had CEOs, we've had calls with the carriers, and we tell the carriers, look, we're going to have the company on the call to hear, your explanation of the claims data and why your renewals, where it is. And and it does help, by the way. You're right. We don't obviously want to embarrass ourselves, but a lot of times we can negotiate pretty well on our own behalf. But having the client on the call is not a bad strategy sometimes.
Yeah. Okay. Well, good. Good. Now I won't feel so bad when I insert myself next time.
No. If you think about it, because back to this conversation is, it's a big game, right? Even though we're the largest player with these carriers, it's still a big game. We're still saying at the beginning of the call, this company is willing to move if you won't bring this rate on. And we have
that from you every time.
Right. We have United over here ready to give them a better deal. And, the secret, it's not a secret, but if you're willing to move carriers in the first year, you can usually get about a 6 to 8% discount. So it's something like auto insurances, they're going to get that money back over the next couple of renewals. But my point is that, if they're on the call with the employer themselves, they can ask that question. Do you want to stay with us? Is it your goal to stay with us as a carrier? Because then they know that you're not playing the games. But anyway.
So I'm still going over different cost savings tips. I don't know if this would fall in the controversial category or if it's just good business. But I've seen employers, what they do is they incentivize the lower plans. So they cover less of the higher cost plans, and they subsidize more the lower cost plans in order to encourage employees to take the lower cost plans, which are generally less feature rich, higher deductibles, and a lot of the younger, healthier employees migrate to those, and because they're happy to. But that's one way to lower costs, because that means more people are enrolling in the lower cost programs. Do you see that as a common strategy, or am I just dealing with unethical companies?
No, you're 100% right. And when costs keep going up, employers, they need to figure out how they can absorb these costs. So the cost sharing, the employee cost sharing has become something that has to happen. So, that means you have to really educate your employees on what's going on in the marketplaces, with the, but yeah, so that, you take more of a tiered approach now. You might have the same exact plan, but there's different tiers, right? With a higher deductible, higher coinsurance. This plan, the employer is going to contribute more. They're going to, they're going to give you a bigger, HSA contribution, for example, to push employees toward that plan. It's a lower cost plan. Employees kind of bearing more of the costs, but the employer might make a contribution to that plan in order to push them in that direction. And if they want to go to the higher tier plan, they're just going to absorb more of the cost.
Okay. Yeah. Fair enough. I think there's two strategies there. One is what percentage the shares in general, just and be passing on that increase. How much of that increase do you pass on to employees? And the other aspect is, do you tier your approach where you incentivize them to take the lower cost programs? The other aspect that I caution employers about is some employers, they really want to be good to their employees, and I admire and respect that. One of the issues is that they offer a more generous plan, and then what happens is that you have a lot of married couples, and the married couple decides, well, we're going to come to this more generous plan. And so the employer ends up subsidizing another employer's plan that is not as generous, so that the other spouse or husband works for. And so if you got to be careful if you offer a robust plan that too many people might take you up on that, and you actually end up increasing your costs and making up for another company's deficiencies.
That's 100% right. That's a lot of the strategies that we'll use is, we'll see a lot of, spouses or children on the plan, and, they're not, if they have the ability to go on their own plan, but they're utilizing yours, it's because it's usually you're being a little too generous. But it all depends. It depends on, we do a lot of benchmarking now. That's become a big thing, whereas government contractors are, as you know, it's very big in this area, the government contracting firms. So our companies are constantly asking us, we're trying to find, retain, attract, good employees. So we need to benchmark our benefits to other, same similar size companies in the same space. So we'll do a lot of that. And that's where some of that can come out, is what people are offering, and, how to incent them to maybe have their working spouse go on their other plan.
Yeah. If you're going to be generous, it might be better to be more generous on other type of benefits. And then what about we had at least offers to, like, kind of gatekeepers, and the insurance companies offer these, where essentially, rather than employee running immediately off to a doctor because they have an ailment or something like that, they have essentially a gatekeeper, which sometimes is voluntary, sometimes mandatory, I guess, that you go to these individuals that will kind of help you manage your care. And that's supposed to be a big cost savings. What are you seeing in that regard lately?
Well, it's funny. The gatekeeper model was something that we saw a long time ago, right? The HMO model, where you had to go see your primary care physician, and they would be, they would give you a referral in order to see a specialist. So they kind of controlled it that way. And, although it's a little different now, it's, what's the term, like care navigation now, but that's what you're seeing, that gatekeeper model again, where they might be using some sort of digital tool or a nurse that are helping members find that right level of care at the right cost. So it's gatekeeper. It's coming back. That modern. It's more of a modern.
In what way is it coming back? Like, is it mandatory? For the times I've used it, it wasn't mandatory, but you were encouraged. It was an offer that, hey, why don't you make your first call here? What are you seeing? Do you see anything where it's mandatory at this stage? Other than HMO, like you're saying, yes, from that model is a gatekeeper.
It's like you said, it's not mandatory. Usually not mandatory most of the time, but there's ways to incent employees to kind of start out that way, with wellness credits or premium discounts, or just internal in the companies. You can kind of direct those employees to start there to push people to that direction.
What other, like, if you were to say cost savings tips with our listeners as they're going through here and facing it, anything else that you feel like we haven't covered that's a big one that we ought to be hitting?
For a company, the word outsourcing has become a very big thing in the marketplace. Whether you're using an outsourced C-suite CFO or head of human resources, that's a different sort of outsourcing. But the outsourcing we're talking about is outsourcing your benefit administration or your enrollment or compliance to these specialty type programs. That allows HR to focus on kind of what they're doing. But if you can select vendors who integrate well with payroll and HRIS and they kind of streamline the data and the reporting, that can help with cost savings if you're doing that.
Because you have less, that's more administrative overhead because you trim administrative overhead to manage something. And I think that makes a lot of sense in this, because if you're a company, you have one or two people dedicated to that function, you're not getting the economy of scale you would with a company that does this for a living for 30, 40 companies. You run into problems and challenges. Well, for one or two person shop, that can be very difficult because you're not sure how to handle unique situations where an outsourced company does that every day and they know exactly how to navigate and how to efficiently operate.
Exactly. And what we try to do as a company is have those relationships with those vendors. We try to, if a client comes to us and says, we're not really happy with our payroll vendor. So we'll kind of say, well, look, knowing your company, knowing you as a client, we would suggest probably these 3 or 4 carriers that would integrate well with what you're doing, kind of fit your needs. We'll set up demos for them. And because they come through our relationship, is they would probably get a discount versus going to them directly. So we have those vendors that we try to integrate into the platform, which there could be some cost savings. And also, long term is that data, again, collecting that data through those vendors helps with kind of keeping costs down long term. It's employee engagement. It's having that knowledge.
Yep, makes sense. And then what is, I want to say more broad, not just AI, but I guess technology in general. What is changing in that front that is going to influence this industry? There's been some talk that eventually, rather than my first step will not be seeing a doctor, and one day it'll be actually seeing an AI who will give me their thought based on my inputs and those type of things. And then you always have the option of going to a doctor. You think AI is going to have a major role in healthcare coming forward as far as employee? Obviously research it might, but I'm talking about actually what employees will have to deal with, what employers will have to pay for. What do you think the role of AI is going to be?
I definitely think AI is it's transforming a lot of industries. I mean, I think the human element is definitely always going to be needed in our industry, but it's how we manage data. It's communication. It's predictive analytics. They can identify kind of the potential high cost claimants early on.
And the advantage for doing that is that means you might be able to do some preventative care is what.
That's right.
As soon as you recognize someone that goes in and they have X, Y, and Z diagnosis, that you now know their risk for these 3 complications from that, and so you can try to address those earlier and up front.
And then from our side, maybe the generative AI can help us produce benefit summaries or the enrollment videos, or just kind of be more efficient on that end, which allows us to focus more on strategy. But just AI can help us put together these analytical dashboards, so all these systems feed into that. So again, kind of knowing your data, controlling your data, kind of keeping not only the employer from the money side, but also helping your employees understand better the preventive care that you were mentioning. So the AI can definitely kind of predict things and push people a certain way.
Okay.
I hope that's what you were asking, but.
It is. And I think there's really what you're saying is that there's the administrative aspect of it that AI can help with. I was wondering which part employees will see. And you said like maybe some of the onboarding and training and those type of things. It doesn't sound like you think it's going to start somehow substituting for doctor visits anytime soon, or going to be advising. You're going to have them advising employees based on what elements they share with an AI. And certainly not doing prescriptions and all that type of stuff.
People are already doing that, right? I mean, I think you and I are probably already doing that. Is you have some offer some condition, and you kind of type it into ChatGPT and you describe it, and you kind of figure out maybe what could it be, or what's going on with your child that has this condition. So I'm not sure doctors like that so much, because they're probably like, no, that's probably not it. But I think it can at least put people at ease, or kind of narrow down what they think is going on. But I don't think it replaces modern medicine, but it definitely can help maybe with the upfront prevention, or early, the virtual visits, or, save people some time.
You bring up a great point, in the sense that whenever I have something, my first step is actually always to go online and have them see and I would have to say, inevitably, I've almost always found what is the common answer to that, and found a solution. I'm sure it can be dangerous, because sometimes it can be something more serious, and you think the Google's or ChatGPT has solved your issue, but I have found good success, and I start there. So it is a great point that in some ways we've already been using technology to try to self-diagnose.
100%. Yeah, I do the same thing. But you're right; it's not a replacement, but I think it makes people more efficient, and at least kind of can help push you in the right direction. So.
Okay. Now, before we wrap up, I just want to kind of throw out, make sure there's nothing that you can think of that I probably should have asked and didn't ask, that you think that someone who's dealing with health insurance for their company and trying to manage that cost, is there anything that we should advise them on, other than give you a call?
We try to just educate our employers, the C-suite, on how to maybe the cost aspect of it, predicting where the market's going, and where we see, benchmarking data. And then, on the HR side, is we really try to help them with employee engagements, because I think a smarter, more informed employee will have better outcomes when it comes to claims. And not only that, but understanding, a lot of employees are seeing a 20% increase in what they're paying, and they get upset. But if you educate your employees, and you kind of help them understand why costs are going up, maybe they'll take a more active role in trying to keep, their strategies, they're taking care of themselves, preventive.
Through we didn't get into it, but like the wellness type of programs a little bit, as far as if you establish wellness programs and you can make a healthier employees, and then theoretically they will need less healthcare related. I have that in my book, and I do believe that is true. You can't always measure that, right? That correlation where you implement a new wellness program and you immediately see a change in your claims. But there's been plenty of studies showing there's a correlation in that.
Yeah, 100%. I mean, wellness used to be counting your steps, right? Now it's managing, disease management. There's a lot more things involved with exercise and mental health. And I mean, mental health, we didn't even really get into mental health, but that's pharmacy, drugs, and mental health are the biggest drivers of healthcare right now. So, that employee education, as far as making sure your employees aren't too overwhelmed and stressed. I mean, the mental health piece has become a huge thing that we educate on.
Great point there. Yeah, having work-life balance and many aspects, a stressful work environment will absolutely take its toll on your employees. That's
right.
a great point. Keith, I want to thank you this has been very helpful. I hope listeners and viewers had a chance to learn a little bit more about health insurance and how to manage that cost within their companies. Thank you. And I'm sure it's one of these things that in 12 months, so much has changed that hopefully you'll come back on and give us an update.
Thank you very much. Appreciate your time, Dwayne.
Thank you.